First, thank you for coming on to here to talk more about ratespy.com. And it's a real pleasure as the president of Rad Marketing to have you on. I don't know what you call it, but what do you call people who are RateSpy fanatics and check the website daily for updates on mortgages? Is there a terminology for that?
Call them special agents.
Okay. Well, I'm a special agent because I'm a fanatic of your website. I think what you do is incredible to not only the public in general. I've actually negotiated probably 3 or 4 of my recent mortgages because of ratespy.com. And I've been in the business for over 20 years and sold 10,000 plus condos and know every lender in the city, and I only get better deals because I go on to RateSpy. So thank you for that, and I'm sure a lot more people that will be listening today will be logging on to RateSpy to find out more about what you do. But maybe before we
Thank you.
start, about what ratespy.com is and what your mandate is, and what separates RateSpy from other mortgage comparable sites.
Yeah, well, again, thanks for having me on. It's great to be here with everyone. RateSpy is a site I started because, I knew where the market was going. It was going online, and, people start searching for a mortgage, and they usually these days start on Google. And so it's paramount to be at the top of Google if you want to generate business. So way back when, it's 2009, we started developing the site. The thing that we wanted to be different with is that we wanted to be objective, whereas there's other rate sites out there. Won't name names, but they generally operate on a pay-per-view model. So if you're an advertiser and you want to be seen, you pay them, and you get you appear prominently on the site. With us, we wanted to actually make it a completely objective source of rate data. We weren't sure exactly how in the beginning how we're going to make money doing it, but we figured it was important to, if you give people the information they want, then generally somehow you find a way to monetize it. And so we have all lenders that publicly advertise rates, whether they're advertisers or not, or pay us or not. And we compare them all, and you go on the site and you enter in your criteria, and it shows the rates that match your criteria. It's mainly for owner-occupied homes right now, but we're adding a rental component soon.
That's great. Well, thank you for that. I'm just going to ask you a bunch of questions about what's going on. So at Rad Marketing, we've sold, we're mainly in the pre-construction condominium side. Myself and my team, we've sold close to 10,000 condos in total. We've done projects like the Shangri-La Toronto, King Toronto, which is on King West, the St. Regis, Aura, Canada's tallest condo, and the list goes on. And we always have questions from real estate agents and clients about, the mortgage side. It's always changing on a, daily basis. And so having you on will be able to hopefully help some of these, the agents and their clients understand what's happening in the mortgage market, which is really important right now. One of the things that I noticed that when I log on daily to RateSpy is that, bond yields are falling at record levels right now. And I believe that you'd noticed that you'd mentioned that HSBC has got now a 1.99% mortgage, which is a 5-year fixed rate, which is unheard of. Where do you see mortgage rates going in the next 6 months to a year, both on the fixed term and also on the variable side?
Yeah, so I would start all this discussion with the fact that rate predictions are meant to be wrong. So, just like I would say most people probably didn't expect the stock market to be near all-time highs this quick. Crazy things can happen in the rate market. So the best we can do is kind of look back at past recessions and extrapolate from there. So, generally speaking, when you have a severe unemployment, you get a rebound. And, after anywhere from 12 to 18 months, rates, go sideways or start drifting higher. The market prices in inflation expectations, 18 to 24 months in advance. So, if there's going to be a recovery in 2022, we're going to start seeing it in the bond market in the not too distant future. bond yields have been going sideways, and bond yields, as everyone probably knows, are key for determining the direction of fixed mortgage rates. They've been going sideways for about 7 weeks or so. They just started springing higher, showing signs of life. I don't know if that's going to continue or if we're going to make new lows. There's definitely a lot more negativism to come in the Canadian economy. The final shoe hasn't dropped, and so it's possible we could see rates drift down a little bit lower. But um, all that said, right now, like you mentioned, you have 5-year fixed rates near the twos for uninsured and below the 2% range for insured. And we've never seen major banks advertise below 2% on a 5-year fix before. So even though it's uninsured, it's definitely symbolic. And so side, you have the Bank of Canada very hesitant to even talk about negative rates. They probably aren't going there in this business cycle. Maybe the next recession, they don't have a choice. But this time around, we've probably seen the low for prime rate. So you got to ask yourself, if you're looking at fixed versus variable, what's your upside to picking variable when you're saving 20 basis points or so versus a 5-year fix. So a lot of people are thinking that way. In first quarter, CMHC, 96.6% of its mortgages had a fixed rate. And so there's just an overwhelming interest in fixed right now, and I think you're going to see that continue. So right now, from a standpoint of an investor, what do you do with rates? Do you go long-term, short-term? Totally depends on, your holding time frame for one. We deal with portfolio investors that, buy a property and plan to sit in it for a decade. We've actually had some people even interested in a 10-year fix now that they're below 3%. I wouldn't necessarily recommend that, but it depends a lot on your holding time frame. So you're going to tell me, you're going to buy a rental, maybe you'll have it for a year or 2 or 3 years. Obviously, you don't want a 5-year fix because there's pretty severe penalties there if you break it. So term selection is very borrower specific.
Now that we're in this new era, have the banks changed their banking qualifications for new mortgages, and how does that affect the self-employed and people that don't have the income qualifications or new immigrants that are coming in?
Yeah, so generally speaking, the whole industry has tightened up a bit since the whole COVID epidemic broke out. It's generally incremental. You saw CMHC, for example, announcing its insured mortgages changes, and we haven't seen anything really that head turning on the uninsured space. But banks are making internal modifications, so maybe they're not making the exceptions that they used to. Maybe your credit score is below 700 and your debt ratios are near 44%. Maybe they're not approving those deals, whereas they would have a year ago. Appraisers being more conservative in many markets, and it's very region specific. So, comparing like Toronto, for example, to like Calgary is like comparing, heaven and earth. It's just very different. So different economic dynamics, obviously, in different places impact valuation expectations. So, lenders are factoring all the risk factors right now. We've seen massive increases in loan loss provisions, and so banks are being careful. And so it's that borderline deal that, like I said, we could have gotten done a year ago that aren't getting done in the prime space right now. There are certainly a number of non-prime options. When you talk about self-employed folks, so if you can prove income, you're self-employed and you got 2 years of tax returns and you can prove that 2-year average of income and it's sufficient to get the deal done, great. If you can't, there are still non-prime options out there. We haven't seen the non-prime options disappear at the institutional lenders, at least. Things are a little different discussion in the private and mortgage investment corporation space. That liquidity's dried up there a bit. But on the institutional side, the home trusts, Equitables, Haven Trees, those guys are still lending at pretty good loan to values. So there are lots of options left.
And we in pre-construction, we ask clients to hold their mortgages for close to 2 to 3 years. Do you see, banks getting more aggressive on pre-construction business, if you know that, or alternate lenders? Because when you always come into a sales office, we hand you from a top five, one of the top lenders that will hold the rate at posted rate for up until when you close on there, and then they usually say they'll give you the best deal, 6 months before closing. Is there any other way to be able to get the best? I mean, when you go on RateSpy, you know what that rate is, as of today. Is there any other way that, buyers of pre-construction condos can find alternates versus going to the big banks to try and get the lowest mortgage rate?
Yeah, so on new construction, you have generally the builder's bank that's going to provide you that long-term, 2, 3 year rate holds. And um, that is a market that really has never developed significant liquidity. You can, if you're within a year of closing, you got more options. If your property is not going to be ready for occupancy for a few years, then really you have, made the builder's main bank as your number one option, and the rates aren't great, as you know, and so generally speaking, though, we advise folks to, get approved, get that rate hold in, and then once you're within um, 1 year of closing, or even 120 days, of course, then you can obviously find usually much better options, assuming that the rates go sideways to down.
Um, what about those pure investors looking to rent their units out, put it in a corporation? Has anything changed on banks with that and their criteria? Are they tightening on the lending side on rental units through corporations? Are you seeing any of that?
It's another example where exceptions are fewer and further between than before. Still lots and lots of options for rental financing. Um, so yeah, I wouldn't say that there's any significant trend in that space, other than the fact that lenders just being more conservative in general, and it's very property specific, very region specific. It's just the lenders are very aware of the supply demand dynamics that go into the local rental market where they're lending. So it really depends on the place.
Um, what are you seeing on the alternate lender side versus private lenders? Are you seeing uh, alternate lenders still getting aggressive on there? Are there still private lenders? I know that there's liquidity issues on there. What are you sort of seeing in the market in that space, those two spaces?
Yeah, so institutional lending in the non-prime space hasn't dried up like some feared. There was a pop in rates back in April, but we're seeing very good pricing now, return to the non-prime space from institutional lenders like the Home Trust, Equitables, and so on, and some large credit unions. Um, on the private side, on the mortgage investment corp side, those folks are a little bit more skittish, a little bit more conservative, I would say. They obviously have different capital structures, not as much liquidity as the big guys. Fortunately, we didn't see any spike in deposit rates that was sustained. The government stepped in and kept credit flowing, even to non-prime lenders, which is just so important. And so, yeah, I mean, the market right now is surprisingly healthy for what we just went through.
Um,
Now, that said, I mean, you need 85% loan to value in Calgary on a rental condo. If you can find somebody to do that, I'd hate to see the rate that you're paying. So again, it's very region specific, property
right.
specific.
Um, are you seeing, like, one of the things that's interesting when you talk about is the risk factor um, is still in with banks, where they're not dropping their rates to what the bond yields are. because they're still keeping a premium on the risk on there. Are you seeing that risk premium starting to dissipate today? I know HSBC has done that, but what about the other major banks? Are they going to start following suit with that, or are we going to see them trying to maintain their margins across the board?
Yeah, definitely. The banks are going to follow suit unless another shoe drops. So if you got, a second wave of COVID, obviously all bets are off. You have employment deteriorate further instead of improve significantly, like we saw last Friday. Then the the outcome obviously will change. But for now, assuming the positivity continues and the market keeps recovering, then the spreads are going to recover. So right now we're about 30 to 40 basis points above normal on 5-year fixed pricing, and that's largely the credit spread still a little bit wide. Investors waiting to see how things pan out for the remainder of the year. You still have extreme loan loss provisions that banks are pricing in to mortgage rates, and so it's going to take a little time. If you look back at the global financial crisis, 2009, it took 9 months for things to get back to semi-normal. If you recall, back then we had extreme inflation of variable rate pricing. We saw prime plus a point back then for a period of time, and but after about 6 to 9 months, things improved significantly, and the same will happen this time, assuming that we continue recovering through the remainder of this year.
So what is the best way to keep your cost of borrowing low? Because everyone asks me that. I mean, I know the 5-year rate is going to unbelievably low levels, but there's also, I mean, I've instituted this before in some of my properties where I do a 1-year rate and then a refinance after that. Going forward, what do you suggest with the least penalties? What would you do if you are an investor looking at buying a condo and closing in the next 6 to 8 months? What's the best method?
Yeah, so you hit the nail on the head with penalties. So a lot of times, investors will expect to hold a property, for about 5 years, whatnot, and end up selling it after a few years because they got a good offer. They want to move into a different project, whatever. And so the short terms around the 2 or 3 year tend to be pretty popular with a lot of our investor clients. 5-year terms from balance sheet lenders that charge extreme penalties, we generally try to steer people away from that are in the investor space. Back in the day when the spread between 5-year fixed and variable was a point or more, it was a much easier discussion. You just went variable, and if you had to break, you had the 3-month interest penalty, and great. These days, with the spread down to like 20 basis points in some cases, it's people are spending a lot more time thinking about it before they decide to go short term or variable. So you want to keep your options open, though, if you're a rental property investor. We've seen more borrowers as of late consider HELOCs and slapping those on a income property and doing interest only. I don't necessarily recommend that. Very depends obviously on the borrower, but to keep those payments low and keep things cash flowing, some people have done that.
Where do you think the first thing that I see with clients is they first go to the lender as they get closer into closing, rather than going to a mortgage broker and trying to shop the deal. What's your recommendation for that? Because it's always been a perception to go to their bank first to try and get their rate. I think it's just a misconception that when they go to their bank, because they're a loyal client, that they should get the lowest rate on there. But after I'm watching with RateSpy, and including my own banks that I've had, I've realized that not even my bank would give me as low as a rate as some of the rates I see on RateSpy. So what's your recommendation to people who are investors who are looking at closing, or end users as well? What should they be doing?
Yeah, so just in general, if you're an ultra well qualified borrower and you can get approved anywhere, then obviously you're going to have more options, and shopping around can definitely help. If you're someone that might have trouble proving enough income, and you're relying heavily on rental income, for example, to qualify, then the rate takes a back seat to getting the deal done. And so that's where you really need to work with someone who has done rental financing for ages and knows all the different guidelines and the different lenders out there. And there are, vast differences in lending policy, whether it's how a lender treats a rental income, for example, how much rental income they allow in the deal to qualify, the number of doors that the lender will allow. There's just so many things that come into play, especially when you start getting into your fourth and fifth and beyond rental properties. So yeah, but generally speaking, you're ultra well qualified, then you have to shop around, because if your average mortgage in this country is somewhere around $300,000, and you can save 20 basis points, roughly $600 a year times 5 years, it adds up, and you add compounding in that. And, especially if you have multiple properties, it makes a difference. So there's still a lack of transparency in the banking space. You have banks, I won't name names, but you have banks where you can get a rate that is literally 40 basis points less if you go online than you can get through mortgage brokers at that bank or that bank's internal sales force. It's crazy. Yeah. So there's a shift. It's going to be interesting to see how it plays out in the next 5 years. There's a shift to online origination because it's cheaper for banks. You don't need a branch. You don't need to pay someone commission. So we started seeing kind of a shift in that direction about a year ago. And I think that over the next 2 years, you're going to see banks competing a little bit more head to head and a little bit more out in public on these deep discount online rates.
That's great. So when we came out of the financial crisis last time, and I remember it well because, I was launching a project and I had to put it on hold, and, we had to wait till around 2010, 2011. And we saw rates start to, fall gradually, like you said, over the 9 months. And then come 2010, 2011, the market just lifted, primarily because mortgage rates were at record lows, and supply was very low. My gut feeling is that right now in the resale market, we're having very, low supply in there. Builders have delayed launches for, into the fall and into next year. So the number of launches compared to last year are 60% lower. And, now that interest rates are falling, do you feel that there's going to be an uptick? I'm particularly Toronto versus other cities across Canada. Do you see that there's going to be an uptick in real estate sales as we go along, as these rates start to fall?
Yeah, as more listings come on the market, you're going to get more sales. Realtors for the most part have done a good job at counseling folks about when to list their property and whatnot. We haven't seen a whole lot of panic selling. We saw obviously national price weakness over a month ago, but that subsided now. If you watch, I like to watch this House Sigma site and see what
I love that
projects. Yeah, see what it projects for prices. And I think last time I looked, it's like projecting record high prices in the GTA. It just boggles your mind that the how the market's held up. Generally speaking, you go back in time, recessions aren't good for home prices. And so pretty much all of Bay Street's expecting weakness in housing prices. But this unbelievable lack of supply, despite all the demand pullback from skittish buyers and from immigration slowing down and all these other negative factors, has just offset those negative factors, and prices are holding up. So to the extent that rates stay low, that's more fuel to the market. If we ever see the qualifying rate come down to a reasonable level relative to bond yields, then that's even more fuel on the fire. And I don't know if the government's going to ever implement that easier stress test that it promised for April 6th that kind of got shelved. But if that happens and rates stay flat, we could see, a half point come off of qualifying rates, and that's going to be pretty good juice for the market.
That's great. Well, Rob, I want to thank you so much for coming on today and talking to us. I encourage all the viewers to go onto ratespy.com and really research your mortgage before you actually commit. The content that you provided to us is great for our viewers, for the real estate agents and stuff. And we hope to have you on again, and look forward to picking your brain on items in the future on the mortgage market.
Excellent. Great to be here. Stay safe, everyone.
Thanks so much. Take care.